If you're using Bitcoin as collateral and checking the price every hour, something's wrong. A Bitcoin-backed loan shouldn't feel stressful. If it does, you're probably mismanaging your LTV, the single number that decides whether you sleep well or get liquidated. Your LTV determines how much room you have before margin calls hit and how far Bitcoin can drop before you are forced to react. In this video, we'll break down what LTV really means and how to manage your collateral health confidently on Firefish. Let's dive in. LTV stands for loan to value. It describes the relationship between your loan amount and the value of the Bitcoin you lock as collateral. And here's the key thing. LTV is not fixed. It moves up and down with the Bitcoin price. When Bitcoin drops, your collateral is worth less, so your LTV goes up. When Bitcoin rises, your LTV goes down and your position becomes safer. For example, if your Bitcoin collateral is worth $10,000 and you borrow $5,000, your LTV is 50%. On Firefish, you can track this through the Collateral Health Indicator, or CHI for short. CHI translates your LTV into a simple percentage score that shows how safe your position is. A loan that starts at 50% LTV begins with 100% CHI. If you over-collateralize further, for example by locking more Bitcoin than required, your CHI can rise above 100%, such as 150% or even 200%, increasing your safety buffer. The indicator updates in real time as the Bitcoin price moves, giving you a clear and intuitive overview of your collateral health at any moment. Although a 50% LTV is commonly used, it is not automatically safe. Bitcoin is volatile and a fast price drop can push your LTV higher much quicker than people expect. That is why a 50% LTV can still lead to margin calls or even liquidation in a sharp downturn. Choosing a lower LTV, which means locking more Bitcoin as collateral, gives you a bigger safety margin, better collateral health, more time to react, and a significantly lower liquidation price. Here's the difference between margin calls and liquidation. A margin call is an early warning that your collateral is getting low because the Bitcoin price has dropped. On Firefish, you get 3 margin call warnings before liquidation, which gives you time to respond. When you get a warning, you have 2 main options. You can top up your collateral by adding more Bitcoin, or you can request early repayment. If you choose early repayment, keep in mind that the lender has to accept it, and you are still exposed to liquidation until the repayment is fully completed. If you do nothing and your collateral health keeps falling, the loan can eventually be liquidated. Liquidation means your Bitcoin collateral is used to cover the loan, so the lender gets paid. On Firefish, liquidation happens at around 95% LTV, meaning your loan is about 95% of your collateral value, leaving only a small 5% safety buffer. So how do top-ups work on Firefish? If you decide to top up, it's pretty straightforward. You open your active loan on Firefish, hit top up collateral, and follow the steps on your screen. You'll send additional Bitcoin to the escrow address. Once the transaction is confirmed on the Bitcoin network, your LTV drops, your liquidation price drops, and your collateral health improves. Many borrowers top up after a margin call, but it can also be a smart move if you simply want more safety. Finally, let's look at conservative versus aggressive LTV strategies. A conservative strategy means choosing a low LTV, which requires more Bitcoin as collateral, but reduces the chance of margin calls and liquidation. For example, for a 10,000 euro loan at a 25% LTV, you would lock roughly 40,000 euros worth of Bitcoin. That gives you a large safety margin because Bitcoin would need to drop by roughly 74% for you to reach liquidation. An aggressive strategy uses always a higher LTV starting from around 50%, which is the common minimum on Firefish. So for the same 10,000 euro loan at 50% LTV, you would lock about 20,000 euros worth of Bitcoin. You need less collateral, but you will hit warnings sooner if the market drops. In simple terms, lower LTV buys you safety and time. Higher LTV gives you more leverage but less room for mistakes. So be honest about your risk tolerance and choose your LTV accordingly. Better safe than sorry. That's the core idea of today's video. Manage your LTV, watch your warnings, and use top-ups early if needed. If you have any questions or suggestions for future episodes, drop them in the comments below. And if you want to learn more, we've put some great resources in the description. You can check out our books in multiple languages at firefish.io/book. They're also available as audiobooks now. Thanks for watching, and I'll see you next time.